Welcome to today's Explainer, where we're going to completely unpack a highly complex institutional strategy report to see exactly where the smart money is moving in the digital asset market today. Our benchmark date is August 28, 2026. And let me tell you, the data we're seeing right now is absolutely fascinating. We aren't just looking at prices ticking up or down. We're doing a deep dive into the structural forces, the on-chain liquidity flows, and the macroeconomic policies that are fundamentally driving these valuations.
So, we've got a lot of ground to cover. We'll start with the macro liquidity clash, track the billions in new stablecoin inflows, examine this incredible tug-of-war happening with Bitcoin, look at the altcoin rotation, and finally, we'll lay out the concrete strategic action plan that institutional researchers are recommending right now.
All right, Section 1, the macro liquidity clash, Fed tightening versus Treasury liquidity.
To really understand the markets right now, we have to start with this fundamental paradox, this absolute clash between two branches of the U.S. government. On one side, you have the Federal Reserve playing the ultimate hawk. Headline PCE inflation is sticky at 3.7%, and Fed Chair Kevin Warsh is holding the line at a 2% target, giving absolutely zero forward guidance at Jackson Hole. But, and this is a massive pivot, on the exact opposite side, the U.S. Treasury is acting like a massive dove. Starting September 9th, they're doubling their 10-year and 30-year bond buybacks from $2 billion to $4 billion per operation. So the Fed is threatening to squeeze the economy with high rates, while the Treasury is quietly turning the liquidity spigots back on, directly easing the pressure. It's wild.
What's truly fascinating about this dynamic is how the traditional fear of high interest rates is just being completely overshadowed. Normally, if you saw a 75% chance of a rate hike by year-end on CME FedWatch, combined with 30-year Treasury yields jumping to 5.21%, that would absolutely crush risk assets. But institutional investors, they're looking right past the Fed's tough talk. They know accurate forecasting is just an aspiration, as Warsh said. They see the Treasury's bond buybacks acting as a backdoor liquidity channel, structurally benefiting scarce digital assets. The market has realized the Treasury simply cannot afford to let the bond market break.
Moving on to Section 2, stablecoins and capital inflows. The dry powder accumulates.
$5 billion. That massive number is the exact amount of new USDC stablecoins minted by Circle in just the last week. Think about that for a second. That marks the largest single weekly mint we've seen since early 2026. This isn't retail traders throwing a few bucks around on a weekend. This is a tidal wave of institutional capital converting fiat into digital dollars, loading up their cannons, and getting ready to deploy.
So the crucial point here is that this fresh liquidity isn't just sitting idle. Total stablecoin market cap has crossed a historic threshold, hitting $303.72 billion. That's up roughly 14% year over year. We're seeing what analysts are calling a complete digital dollar reflation. And right alongside this, tokenized real-world assets have exploded by 80% just this year, reaching $38 billion. The entire plumbing of the crypto ecosystem is currently being flooded with that very liquidity the Treasury is providing.
Which brings us to Section 3, Bitcoin's tug-of-war, bullish inflows versus bearish expiry.
Right now, Bitcoin is caught in this massive battle between spot buyers and derivatives traders. If you track Bitcoin futures open interest, you'll see it fell from 646,000 Bitcoin in mid-August down to roughly 588,000 Bitcoin today. And actually, this drop is a really good thing. It tells us a massive amount of excess leverage has just been flushed out of the system. The leverage bubble popped, creating a much healthier, spot-driven market. We're no longer relying on traders borrowing money to push prices higher.
But there's always a but, right? We have a massive $6.4 billion options expiry hitting the market today with a max paying price of $69,000. With Bitcoin currently wrestling right near that $80,000 to $81,000 resistance level, this creates some serious structural friction. Options dealers have to aggressively hedge their books, and that hedging activity acts like a gravitational pull, keeping a lid on the price in the very short term, even with all those positive stablecoin inflows we just talked about.
This tension has practically split analysts right down the middle. You've got institutional giants like Standard Chartered pointing to continuous ETF inflows, predicting a breakout to $100,000 by year-end and treating that $65,500 level as a rock-solid floor. But on the flip side, veteran traders like Peter Brandt are warning of a bearish head and shoulders pattern. It's a textbook clash, the long-term ETF accumulators versus the short-term derivatives bears.
Let's move to Section 4, the altcoin rotation, high beta winners and losers. While Bitcoin battles it out, we're seeing a fascinating and honestly ruthless rotation of capital in the altcoin market. Just look at this divergence. Solana is acting as the ultimate high beta darling, exploding upward from a $95 consolidation zone to nearly $110 in just 4 days. It's absorbing massive liquidity, including $1.25 billion in USDC mints directly onto its network. Then you have Optimism, a Layer 2 network struggling near all-time lows around 9 cents. After losing the massive Coinbase base network to an independent stack and staring down a massive 343 million token unlock over the next year, it's just getting left behind. Capital is flowing strictly into ecosystems with real momentum.
And you have to look specifically at the quality of this Solana rally. The perpetual futures funding rate is negative 0.002%. That is a massive, screaming signal. A negative funding rate while the price is pumping proves this rally is built on a rock-solid foundation of real, spot buyers. Shorts are literally paying longs right now. There's no precarious leverage bubble waiting to pop here. It's just pure on-chain demand confirming a rotation into high-beta layer 1s.
Now, we absolutely cannot ignore Ethereum either, which quietly reclaimed the $2,500 level this week. We're seeing major corporate accumulation here. An institutional whale known as Bitmine scooped up 32,000 ETH, worth about $81 million, just ahead of the major Glamsterdam technical upgrade. So while it might be moving a bit slower, Ethereum is really cementing its role as a core treasury asset for these large corporations. Finally, Section 5, Strategic Action Plan, the institutional verdict.
So, bringing all this complex data together, how should we actually adjust our portfolios today based on this institutional research? Well, the optimal play right now is a highly strategic barbell approach. The playbook suggests heavily overweighting Bitcoin at 55% and Solana at 17% to capture this specific liquidity wave. You want to hold Ethereum neutral at a solid 25% to respect that institutional buying, and you need to severely underweight those struggling Layer 2s, dropping them down to a mere 3%.
The crucial takeaway here is to let the smart money dictate your strategy. Buy the spot-driven strength. For Bitcoin, accumulate in that $78,000 to $80,000 range, letting ETF inflows act as your shield against options volatility. For Solana, add on any dips near $102. It's the strongest alpha narrative on the board, hands down. Keep your Ethereum steady at the $2,450 to $2,500 mark to wait out the noise. And most importantly, ruthlessly cut the assets that are lagging, like Optimism. Sell on those bounces and reallocate that capital right back into the clear winners.
As you go review your own portfolio, I'll leave you to ponder this massive psychological shift we're witnessing. If high inflation and strict Fed policies just force the Treasury to pump billions more into the system to prevent a collapse, and that liquidity immediately flows straight into stablecoins and digital assets, have we officially entered an era where bad macroeconomic news is actually the best possible news for crypto? The data certainly seems to say yes. Thanks for joining me for today's Explainer, and happy analyzing.